The ultimate guide to investing in the S&P 500, how to build wealth and diversify your portfolio. Are you looking for a way to invest in the stock market that provides diversification, strong and long-term returns, and exposure to the largest U.S. companies? Look no further than the S&P 500. Investing in the stock market can be a daunting prospect for many individuals with a dizzying array of options and potential risks. However, investing in the S&P 500 can be a straightforward and effective way for investors to gain exposure to the U.S. stock market while mitigating risk through diversification. The S&P 500 is a stock market index that tracks the performance of 500 large, publicly traded companies in the U.S., representing approximately 80% of the total market capitalization of the U.S. stock market. This index is widely regarded as one of the best representations of the U.S. stock market and is often used as a benchmark for investment performance. In this video, we will explore the benefits and risks of investing in the S&P 500 and discuss how investors can gain exposure to the index through index funds or ETFs. We will also examine some key factors that investors should consider when investing in the index, including their investment horizon, risk tolerance, and the specific index fund or ETF that aligns with their investment goals. By the end of this video, readers will have a comprehensive understanding of the S&P 500, its advantages and disadvantages, and how to invest in the index effectively. Whether you're a seasoned investor or just starting, investing in the S&P 500 may be a valuable addition to your investment portfolio. What is the S&P 500 index? Investors and financial analysts commonly use the S&P 500 index as a benchmark for the overall performance of the U.S. stock market. The index provides a broad snapshot of the market and is considered to be a reliable indicator of the health of the economy. It is also a popular tool for tracking trends and analyzing investment opportunities. The S&P 500 index is calculated using a complex formula that takes into account the total market capitalization of all the companies included in the index. The formula is designed to adjust for changes in the market, such as stock splits or mergers, to ensure that the index remains accurate and up to date. Investors can use the S&P 500 index to assess their investment portfolio's performance against the overall market. The index's long-term historical returns have been relatively strong, making it an attractive investment option for many investors seeking to diversify their portfolios and capture market gains. Overall, the S&P 500 index is an essential tool for investors and financial professionals, providing a broad snapshot of the U.S. stock market's health and performance. Its composition, methodology, and historical returns make it a popular and reliable benchmark for tracking trends, assessing investment opportunities, and managing portfolios. How does the S&P 500 work? The composition of the S&P 500 index is determined by a committee of experts who assess companies based on several factors, including market capitalization, liquidity, and financial performance. The companies selected for inclusion in the index are meant to represent a broad range of industries and sectors, providing investors with a diversified portfolio that reflects the overall U.S. economy's health. The S&P 500 index is regularly reviewed and rebalanced to ensure that it remains representative of the U.S. stock market. Companies that no longer meet the inclusion criteria are removed from the index, and new companies that meet the criteria are added. The performance of the S&P 500 index is closely monitored by investors, financial analysts, and economists as an indicator of the overall health of the U.S. stock market. The index's historical returns have been relatively strong, making it an attractive option for many investors looking for long-term growth and capital appreciation. In addition to providing a benchmark for the overall performance of the U.S. stock market, the S&P 500 index is also used as a benchmark for many mutual funds and other investment products. Investment managers often use the index as a way to measure their performance against the broader market, and investors can use the index to assess the performance of their investment portfolios relative to the market. S&P 500 index is a widely recognized and important benchmark for the U.S. stock market, providing investors with diversified portfolio of large-cap U.S. companies and a reliable indicator of the market's health and performance. Pros of investing in the S&P 500. Flexibility. Investing in the S&P 500 can offer investors a great deal of flexibility. There are multiple ways to invest in the index, including index funds, ETFs, and individual stocks. This allows investors to choose the investment vehicle that best fits their investment goals and risk tolerance. Transparency. The S&P 500 is a transparent index that is widely followed by financial professionals and individual investors alike. The composition of the index and the weightings of each constituent company are publicly available, which can help investors make informed investment decisions. Stability. The S&P 500 is composed of large-cap U.S. companies that have a history of stability and longevity. While individual companies may experience short-term fluctuations, the index as a whole has historically demonstrated long-term stability and growth. Accessibility. Investing in the S&P 500 is accessible to a wide range of investors. Index funds and ETFs that track the index can be purchased through most major brokerage firms, making it easy for investors to add exposure to the stock market to their investment portfolios. Overall, investing in the S&P 500 can offer investors a range of benefits, including diversification, low fees, long-term growth potential, passive management, flexibility, transparency, stability, and accessibility. While no investment is without risk, the S&P 500 has a long history of delivering strong returns and is widely considered to be a core holding in many investment portfolios. Cons of investing in the S&P 500. Concentrated exposure. While the S&P 500 provides diversification benefits, it is still a concentrated investment in the U.S. stock market. This means that the performance of the index is heavily influenced by the performance of a relatively small number of large companies. Market volatility. Investing in the stock market can be volatile, and the performance of the S&P 500 can be affected by a range of factors, including economic conditions, geopolitical events, and market sentiment. This can make investing in the index a risky proposition, particularly for investors with short-term investment horizons. No active management. While passive management can be a benefit in some respects, it also means that there is no active decision-making being made to adjust the portfolio based on market conditions or individual company performance. This means that investors may miss out on potential opportunities to outperform the index. Limited exposure to international markets. The S&P 500 is focused solely on U.S. companies, which means that investors who invest solely in the index may miss out on potential opportunities for growth in international markets. How to invest in the S&P 500. Investors can gain exposure to the S&P 500 by investing in index funds or ETFs that track the index. These funds are available from a range of providers, including Vanguard, BlackRock, and State Street Global Advisors. When choosing an S&P 500 index fund or ETF, investors should consider factors such as fees, the fund's tracking error, the difference between the fund's performance and the index's performance, and the fund's liquidity, the ease with which investors can buy and sell shares of the fund. Investors should also consider their investment horizon and risk tolerance when deciding how much of their portfolio to allocate to the S&P 500 index funds or ETFs. While the S&P 500 has historically delivered strong long-term returns, investing in the stock market can be volatile in the short term. Investors with short-term investment horizons or low risk tolerance may want to consider a more conservative investment strategy. Investing in the S&P 500 can be an effective way for investors to gain exposure to the U.S. stock market and diversify their portfolios. The index's composition of 500 large publicly traded companies across a range of industries provides diversification benefits, and investing in index funds or ETFs can be a cost-effective way to gain exposure to the index. However, investing in the S&P 500 is not without risks. The index is heavily influenced by the performance of a relatively small number of large companies, and the stock market can be volatile in the short term. Investors should carefully consider their investment horizon and risk tolerance before investing in the index, and should choose an index fund or ETF that aligns with their investment goals and preferences. With the right strategy and approach, investing in the S&P 500 can be a valuable addition to an investment portfolio. Now that you have a better understanding of the S&P 500 index, we'd love to hear your thoughts. Do you think investing in the S&P 500 index is a smart choice for long-term investors? Or do you prefer other investment options? Let us know in the comments below. And if you found this video helpful, don't forget to like, share, and subscribe for more financial insights.